Morning, Chris.
Good morning, my friend. How are you?
Great. I'm Brian Jones. I'm here with Chris Hood, professional trader, world's most interesting man, Marcelo Garcia fan.
Man, I tell you, when you say that stuff, I'm just like the millions and millions of people are going liars, liars. The
They
most
don't
dark
know.
hour.
They don't know. They don't know. Let them let them think. Let them think.
Let them think. That's it, man. Let them think. I still think jiu-jitsu makes you interesting. Doesn't matter what happens.
Yeah, yeah, for sure.
Go. There you go. How are you?
I'm good. I'm good. It's been a last week was pretty good to me, and I've got potential take some profits this week. So kind
Yeah,
of
this week got off to a really good start. Yesterday we closed off five credit spreads. We've had a couple of carry forwards from Friday afternoon. It's been really good. This last week was one of the best weeks we've had in quite a few actually. So yeah, you just got to trade the charts in front of you, man. Don't get put off by stuff on the outside.
Yeah, I was a little. I took a lot of my profits a little early over the week before the weekend, so I
Yeah,
didn't.
one of the things that scares a lot of people is, should I get out now? Can I leave something on the table, etc. So the couple of things that you can think about that will help you. The first one is when you go into a trade, make sure you have enough contracts that you can halve the position at 100%, then leave something on the table. That's strategy number one. Strategy number two would be have an expectation of where the price of the underlying needs to go to. When it hits it, take your money off the table. Stops you from holding on too long. And that's where Fibonacci analysis comes in and setting price targets for the stock. Strategy number three is you can always replace an expensive trade with a cheaper trade. So sometimes I will go with a long call, let that go up in value, close the long call, and add a cheap butterfly. So you put a cheap butterfly on for less than what you paid for the call. Maybe portion of your profit, it's a risk-free butterfly. Later on, do a call debit spread, take off one leg. You can do a lot of things and be creative with the whole keep the trend going and not limit. But awesome for money, man. I'm here to make you money. That's the key.
Yeah, no, I agree. It was mostly the credit spreads that were up enough that I wanted to scrape that money off just
Yeah.
because I've been skewered on those before. So
I think at this point, at this time, I think you've got to take your credit spreads off the table quickly. Like I think that the vulnerability to a sort of pullback in the market, what we have seen though, is any kind of pullback to the 21, the 13 or the 21 has been a really good opportunity to get in. Right. So a lot of people misinterpret pullbacks to sell-offs, right? They don't really know the difference. So we've seen that the last pullback to the 21 was a great opportunity to get in. We know that stocks like Google and Amazon Amazon's starting to turn around after that debacle with the earnings. Clearly Jeff is buying stock again. I don't know who's buying it, but it's repairing itself.
yeah, I have a trade on Amazon right now.
Yeah, and I think that our trade on Google, we got in at the right time. We've got a couple of put spreads that we still have there. We've got some call debit spreads as well. We were playing it up to 2.8, or was it 9 level? It's there now. So, now we just need to be patient. It's a matter of, should we stay in it? Should we take profit? We've got a lot of profit on the table on our Google trade now. So let's see where this week goes. I think it's going to be a good week. I think this September, as much as I've been pretty bearish, thinking that things are going to get hair raising, I don't know. I thought last week with the Fed not really saying too many cataclysmic comments was a good thing. You just have to trade the chart in front of you. Another reason why seasonality is not a predictor of the future.
So yeah, I'm still waiting for that big pullback though.
I think a lot of people are. I don't know if it's going to happen as big as we think it is, because the Fed can't stop the party. Like this is the thing. The party has been going for a while. Everyone has been punch bowl. They're drunk as skunks now. They are wobbling on the side of the table. And the only way you can keep them upright is to continue to feed them. And if you pull the stuff off, everyone falls down, right? And I think that the the mess that they would have to clean up if everyone sort of pukes the bed or whatever, it's going to be painful. So I think they're stuck between a rock and a hard place. There was a comment this morning from one of the Fed regional governors or whatever they are, saying that she needs more evidence that that inflation is at sustained levels for a period of time. But they never give you the detail of, well, how long and how far and how much. They don't say anything like that. So I don't know. I'm not a good interpreter of whatever they say. I don't speak Fed. The only thing that I believe in and that has helped me is not to pay too much attention to all of that stuff, because it's hard to decipher. You know, if you become too wrapped up in the macro trade, it becomes hard to actually apply it into a workable micro trade. It's hard. Like there are some people who are way, way, way smarter than me who can spend hours deciphering that stuff. I don't find it meaningful at all. It's interesting to know that there may be something that will happen on the side, but those I don't think cause the events. I think that the stocks are already positioned to move down, and what they're looking for is a catalyst. So if you avoid the trades that are weak in structure, then those events aren't going to affect it that much, right? So obviously, 2008, everyone got hit. 2020, everyone got hit. I think you've just got to trade the charts in front of you and not be too wrapped up with what's going on outside of your control. I can't control what Jerome says. I'm going to spend very little time thinking about how he wakes up in the morning and what he's going to do. I don't think it's pointless. It's like, well, okay, it's interesting to know. Okay, they're speaking this week. Be sensible about it. I'm not saying ignore it to the point of being reckless. I'm saying they are going to do what they're going to do. And at the end of the day, if they create an environment that is slightly more volatile than what you're used to as an options trader, that's great. I want the volatility. I don't want things to be calm. I want things to be a little choppy. I want people to be nervous, because it's when they get nervous, that's when I make money. So I think it's a tough one for a lot of retail traders. A lot of retail traders at the beginning get sucked into the intellectual sort of pond. They feel like you'll often feel like you need to be an expert on everything. No, you don't. You need one good setup and just stick with your rules. And if you just stick with that setup and stick with your rules, you can make a really good career out of trading. It's trying to search for that holy grail. It's a constant quest for, there must be something better. That's the stuff that gets people into trouble. I found that the system that I've built took me years and years and years of trial and error and all of that. I have no interest in, finding another thing. I'm a bit of an indicator junkie, to be honest. I find indicators save me my time.
Your charts are quite beautiful, Chris.
They're too blinged out. I have to do something. I've got to try and get used to working with less, not more. But the thing is, I like indicators to speed up the time that it takes me to process a trade, right? So that's how I use them. I do not use the indicators in a way that overrule common sense. Okay, you've still got to have a bit of common sense. You still have to have a plan. And indicators don't fix fundamental emotional issues. You can't have an indicator that suddenly solves your problem of inability to trade or your inability to exit at the right time. The amount of times I've said to people, if you're in a long trade and your trade term is 20 days and the 8 moving average crosses over the 13, it's an indicator to exit the trade. How many people stay in the trade with the hope that the 8 will cross back over the 13 tomorrow? And then their 50% or their 20% loss suddenly becomes a 50% loss, then it becomes the 75. Before you know it, the 13s cross over the 21, 21's below the 34, and everyone's losing money. And they go, but why didn't you tell me to get out? And I go, but it's like that story of that guy getting evacuated from a building and the floodwaters are rising. And the helicopter comes and says, no, I'm coming. And he says, no, God will save me. God will save me. And, another helicopter comes and says, no, God will save me. God will save me. And eventually the guy drowns. And he gets up to heaven and he looks at God and he says, why didn't you save me? He says, what are you talking about? I sent like 23 helicopters to help you. And you still didn't listen. The common thing in trading.
Right.
An indicator will tell you what to do, but if you don't have the up here to get it done, indicator is worthless. So that's a big challenge for a lot of traders, is just getting that emotional confidence to be able to do it. So if you have a new indicator, paper trade it. Paper trade it to develop the confidence, and then once you are confident, put a goal in that's a third of what you would be looking for at the end. And then gradually build it up. And your little mental muscle that helps you gets you to that point. Now, whether that takes you 1 week, 2 weeks, 3 weeks, it's not really important. The timing is not important. It's up to you. Trading is about being comfortable. It's about being able to sit in the trade. I teach a day trading course, and I say to my guys, you put the trade in, you walk away. I do that. I put the trade in and I walk away. I go downstairs. I automate my exit. I already know the price at which I'm willing to exit my trade the moment I put the trade in. I don't sit and watch charts. I don't sit and do this. I go down and I can have my 1 minute chart on the screen, and it will tick, 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 and it will close by itself, and it will do all of it. That requires an element of faith and trust in your system. And I know my system works because it works. I'm not going to sit there and doubt it, right? So that mental muscle is something that people need to develop. And if you don't do jiu-jitsu, go and do jiu-jitsu, because that creates that mental muscle. Jiu-jitsu, the problem-solving process in jiu-jitsu is very useful for trading, because you have to have faith in your ability. If you want to pass someone's guard, you better know what you're doing, and you're going to have to practice it and then try it out. And if you don't believe it, you can't go half-hearted into anything. And this is something that's same in trading. You can't buy, 27 indicators and only use 2, and only use 2 half of the time.
Well, that's kind of like the takedown game. You can't if you don't do the takedown with enthusiasm, it's not going to work. You're going to get smashed.
You might find your knees somewhere else.
Yeah, exactly. So you have to go in and just assume that, okay, I know my ability to do this, and one or both of us is going to hit the mat. It may just be me.
Yeah,
but
and you should be comfortable with that outcome.
Yeah. Once in a while, you're going to face plant. You're going to lose your grip.
There's that pre-acceptance of the outcome that's really important. So in option trading, unlike with stock, with option trading, one of the best ways to deal with this is accept 0 straight up front. If I buy a long call, I've already planned in my budget. I've already planned it. Now, if I get out of that long call and I only lose 25%, I've done better than I planned. So my P&L is going to look a lot better, right? So it forces me to manage that exit better. I have to trust my system. That's the thing. You got to trust yourself.
Except that loss acceptance is a really good way to reframe those, where instead of losing 50%, you've gained
50 because you didn't lose the other 50.
Right. It helps out for mentally.
Absolutely. The thing with trading, what helped me was that specific switch over in mentality. When you think about how happy you get when you get a winning trade. I mean, on Friday, we did a trade on SPRT. Was it Friday? Thursday to Friday, we did a trade on SPRT. It was a 500% winner, 400 and something odd percent winner overnight, right? Overnight trade. You get happy with that, right? You sort of you get a sort of euphoria that comes in. But I'm not the same emotionally. Well, most people aren't the same emotionally when they lose as when they win, right? The sort of level of intensity of the emotion is different. Higher emotion when they lose than when they win.
Yeah, there's a lot of research on that. People are more averse
to loss
than they are positive about winning.
Absolutely. So now what the thing is that if you accept a loss in a trade and you're coming out of that trade actually winning because you didn't lose 100, you only lost 25%, you switch this thing in your brain. You start trading a little differently because now you're not losing as badly as you'd planned. You're actually winning in a way. So it's almost like this little trick that you play on your mind. It helped me a lot because I used to have a lot of losses. Like any trader, you have a lot of losses. And you'd look at your loss and go, damn, I just lost another $300, but you just made 2,000 over here, and you're not going, gee, I won 2,000. My net for those two trades was 1,700. Woo, no one's doing that.
I found that if you break out the windows in your house, it makes you feel a lot better about losing.
Yeah.
Then you lose twice because you have to replace the windows. But hey,
No, it's this little mental game you're playing with yourself all the time. The biggest enemy of a trader is not the market. Everyone thinks it's the market. They think it's the Wall Street bets or CNBC or whatever it is. When they're trading, blame the market for anything that goes wrong. Trade goes wrong, market went against me. Trade's bad, market. They never take accountability. Individual traders refuse to take accountability. I watched a guy on Wall Street bets. I shouldn't really be admitting that I actually go on there, but
find this is like your comedy show, isn't it?
It could be. I look at it and I go, what the freaking hell is wrong with people? There was a guy who dropped $100,000 on put options on a stock prior to earnings. Okay, $100,000. He had snapshots of his account. Okay, I went and looked at the trade. Okay, there was no ways the stock was going down on earnings. No ways. All the indicators were saying it was going up. Stock gapped up. The guy lost 100 grand. Okay. The next day, after he's lost his 100 grand, he posts again, I'm doubling down. Drops another 100 grand in. Stock gapped up again. He lost again. I'm like, what is wrong with people? You literally need just two brain cells rubbing against each other would create enough energy to be able to look at the indicators to say that trade was silly. But when you have losses that are like badges of honor and you don't learn from the loss and he's going to repeat the mistake again, he had 6 million people cheering him on. Like, this is the thing that I can't understand. It's like, the guy loses, he posts, I lost, blah, 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 blah. Everyone's like, whoop, whoop.
It's the same mentality of the people that go to the casino and make these huge bets they can't afford.
Oh my God. I was just like, this is crazy. I mean, I tell my students, like, just stay out of this stuff. Like, don't even go in there. It's entertainment. Honestly, it's entertainment at the best of times. There's nothing more. You're not going to get any value out of it. I find zero. The only thing I'm interested in is what's the next stock that these guys are going to kill? Like, what is it going to be? And then you watch it. And you know what? We only hear of the ones that work. You don't hear of the ones that don't work. And I can tell you now, the hedge funds are not going to let it happen again. They're not going. They killed trade. I think Wall Street bets killed the short squeeze. You can't play the short squeeze the same way that you used to when it wasn't, manipulated, should we say. I don't know. I'm using the word loosely, but man, I just can't believe how people throw hard-earned money. Maybe it wasn't hard-earned money. I'm assuming it's, maybe he's a trust fund baby or an NFL player that earns millions a year. I don't know who it is, but my God, 100 grand?
Seems wasteful. I mean, just on a bet.
I find this is the thing about trading, is that if you're going into trading, trying to be a billionaire, or you're trying to shoot the ball, trying to, knock the ball out of the park every time you trade, you're trading to be right rather than being profitable, you'll lose. It's a loser's game. Because it's a zero-sum game, right? Not all of us are going to win.
I need to take what I've learned, as I've been trading about not going in hard and heavy into my bowling game. Like, I don't bowl very much. And someone asked me the other day if I wanted to go meet some people to go bowling. And I was like, okay, that'd be cool. Here's my bowling technique. I throw the ball as hard as I can at the pin. Okay. So I either usually get a strike or it ends up in someone else's lane. So, and I'm basically going so hard that I'm done. My arm is so tired and my hands are so tired after like maybe 2 games, I can't keep playing unless I get, you just got to get hammered. And then it gets even worse because you throw the ball harder and more inaccurately. So you keep hitting other people's pins.
You and I are very similar. I always go to the bowling alley and I ask them to put the rails on for me. I have to get the kids' rails. Because there I don't mind, because I'm the same. I try and spin the thing, but as you get older and your arthritic wrists start doing it, you can't spin the ball. You can't do any of that fancy stuff. My fingers are so broken from jiu-jitsu, they get stuck in the holes now. So I have to use the one with the bigger holes. So I haven't got a grip. And then it just sort of plops down and then rolls slowly. No.
Flies, like, the ball will like leave my hand and there's like 3 seconds before
you can go to the hot dog stand, grab a hot dog and a drink, come back, and the ball's still going down
in the air, and then it hits the floor. Yeah, with the big thump. Not the best bowling technique, but that
trading's the same. People go hard and heavy. It's almost a thing like this. Is like people will say that in trading, one of the first things you've got to do is blow out your account. Like as a sort of rite of passage, you're not really a trader until you've lost lots of money. Like I just find that bollocks. It's just garbage. That's old mentality. I blew out my account. I blew it out 3 times. I blew it out because I was being reckless. I was being stupid. I did things that I shouldn't have done, but yet that was what was being taught back in those days. And I always look at it and go, why did people say that was the right thing to do? I look at it and I go, because the market was different. The market was different. Now we have information. We don't have an information disadvantage anymore. Our disadvantage with information is we don't know how to use it. And we can't tell the difference between information and just data. That's the thing. So when you have indicators and systems that are built on those indicators, it's the ability to piece these together that builds your system. Most retail traders, they're always looking for the free hack. They're looking for that free, 5-minute thing. And I'm like, it's not there. It's not there. There are some trades like we do, some of our swing trades, which are pretty much, set and forget, leave and forget, come back in a week and they'll be okay kind of stuff.
I like those.
Yeah, those things work for a specific kind of person with a specific kind of goal, But, if people come in, especially to me when I'm doing my coaching and they go, I'm looking for that 5-minute solution, I go, it's not really there, and all this misleading advertising is a little wrong. It's giving people the impression that if you're not doing it in 5 minutes and you're not doing it like this, then you're a failure and you're wrong and you'll trade to that. It's sad.
That's it. That should be like the consulting call would be a 5-minute call to tell you how hard you have to work.
I had a couple of, because I just said something. There's no 5-minute solution. What you're asking for and what doesn't meet what you're willing to commit to. Like it just doesn't match. If someone comes to me and says, I want to make $1 million in a year, I go, okay, cool. And they go, well, I've only got 5,000. Okay, well, you're going to have to trade really hard and you're going to need a really good system. You're going to have to do a lot of day trading first to build up your capital. No, I don't want to day trade. Okay, well, then you can't have your $1 million. It's like, they have to know. So anyway, I mean, you've got to build that process. You've
Everybody
got to build
wants something for nothing.
Oh, it's the modern consumer thing. And then when you tell them that there's no 5-minute solution, they get offended. It's like, well, okay, snowflake, come on, it's not going to happen.
It's the same. So I had some questions. Let's talk a little bit about profit taking. I think that's something that people struggle with. I know you've mentioned this in some webinars, and if anybody is interested in hearing what Chris has to say on his webinars, some really, really good information, technical analysis, trading psychology, trades, just going over to Rogue Investing /Alpha and join the Alpha Hunters program, Paycheck Trade. A lot of good stuff on there. But you were talking a little bit about some profit taking levels, how people set them.
Yeah.
What do you So go into that a little bit if you don't mind.
Yeah, sure. So I use different methods depending on the setup that I use to go into the trade in the first place. I always set it up front. I don't want to set my profit taking levels when I'm in the trade, right? Because now I'm looking at different data, right? I might adjust them, but my initial levels are always set when I go into a trade, right? So with a long call option, right? When I sit down and I do a long call, I need to know that I've got enough contracts on play so I can halve it at 100%. All right. So if I expect the stock to move, and then think or swim, I mean, if what I'll do, let's open up a sheet here. Let's open up a trade. Now I can show you on Think or Swim because this is obviously the platform I use, and it's just a simple tool that they have that I use. So one of the first things that they have in Think or Swim is what we call the theoretical price calculator. Okay, so let's imagine that I've got this trade EFX. Okay, I haven't got this trade. I'm going to go into my chart. Let's go into a chart here. Here's EFX with my blinged out graphs, loads of color.
Very sexy graph, Chris.
Oh my God, it's, okay. So let's imagine, for argument's sake, I have a squeeze. I have my moving averages with momentum. My B squeeze is giving me a score of 100. The stock is going up in price. Okay. So here is my forecasting lines, expectation of price somewhere around 279. I'm expecting somewhere 279 to 290. Okay. Let's imagine 290. We're just going to imagine for this that there's a Fibonacci level in there. Okay. 290. Okay. So 290 from here is $23, right? $23 and a bit of change, 22 and change. So we go into our trading page here, and we look for a $22 expected move, right? So here's the expected move, 19. Here's the expected move, 29. So I know that the market is telling me, that EFX is going to hit that level within the next 45 to 80 days. Right, somewhere here. Now, if this was a weekly traded option, I just choose the time frame closest to the expected move, put the trade in, and then I wait. I wait for the stock to hit that. Now, if I put my 23, because obviously I need my expectation, right? So let's imagine that EFX is going to make the $23 move by October. Okay, remember, the market is telling me there's a $19 move. I'm expecting a $23 move by October. So it's October 15th. So what that means is it's expecting the stock to get to 290. Now remember, 290 is our level, right? So the option that I'm going to buy, let's imagine I bought the 250. All right. So if I buy the 250 and I pay an average price, let's say I buy it for $20. If I get that expected move by October 15, the option will be worth $40.20, right? Which gives me a double, right? So I've effectively got 100%. So on the expected move at that date, I will have a double if I get it. Now, that's a pricey trade, okay, for anyone. If you went and bought that trade by itself, you would need to buy 2 contracts. If your strategy is, well, at 100%, I'm going to halve my position and I'm going to move on. All right, I'm going to leave half to be sitting there risk-free. I'm going to take my capital off the table. I'm going to deploy it somewhere else. So on a trade.
Quick question. Let me interject here. Would you, if you were going to do a more expensive trade, would you rather allocate, instead of buying 2 contracts, would you rather buy multiple credit or debit spreads?
Not necessarily. It's a choice. It's an option. What I would do on something like this is I would do, if I was convinced, all right, so if I was looking here and going, yep, okay, I'm at the 21, this is bouncing, we've got a strong trend, okay, we've got momentum. Let's imagine that this was a very, very bullish trade. There's no doubt in my mind this stock is going up, right? It's 100% guarantee for me it's going up. What I would do is I would probably do what I call a combo, where I buy a long call on the one side of the ledger and I sell a put spread on the other side of the ledger. And what that does is it gives me a credit over here, and I use the credit to pay for the debit. So what happens then is, from my capital perspective, I haven't used a lot of my own capital. I might have allocated some risk capital, but I'm not spending a lot of money because the credit I receive pays for the debit that I pay. So if I bought this trade for, let's say, $2,000, I would need to get $2,000 here, even $1,000. It doesn't matter the ratio. You decide that when you do the trade, but it's the concept. What's that?
Something to defray the cost a little bit.
Yeah, you offset those costs, right? So some people often trade only one side of the sheet. They only trade the debit side as opposed to the credit side. I like to use both. So if I've got a setup, let's have a look. Let's look at a trade. Okay, so here's some of the trades I was looking at today. AVGO, right? So AVGO, I already have a debit spread already here. Okay, I have this 480-520 call debit spread already in play. Now, this trade is already profitable. It's up 20%. But it's cost me $1,900, all right, or $1,600. So I'm putting in play today a put spread for 470, 475 on AVGO. That's a little later in the expiration, but it's down here for a credit. So I'm looking at ways today to take this setup that we have on AVGO here. You can see squeeze, fired long. I've got a squeeze. I've got yes signals on all my entry points. I'm in a bullish trend. This is a great chart. Let's have a look at AVGO. If you look at AVGO, not only did we have a squeeze that's forming and firing to the upside, I have my sell put spread strategy is already telling me to sell a put spread. So I already know that I'm in the vol range of trading here. What I'm looking for is to put my short strike underneath these moving averages. And I know that my B score is at 106. So that's telling me I have a high likelihood that this is going to be a powerful move. Moving averages are aligned and there's option volume being traded. So for me, doing a put spread now, I may be able to get out of that put spread earlier than the credit spread, the debit spread, and reduce the cost of my debit spread before it expires, right? So over the next 16 days. So when you take profits, when I take profits then on AVGO, sorry, if we go back here to AVGO, if we go back to AVGO and I look at profit taking here, I have two choices now. Because AVGO could move up fast. This put spread could start reducing in premium. I then get a profit on that. And I could close this as well and use this as my trade to continue to trade on, take this profit from this trade and buy another call spread later on, right? So now I'm just reducing my capital in that trend. I'm staying with the trend, but I'm using a new trade to finance another one. And then I'm going to use the profits to buy another trade. So you can stay in. I could also then switch to a call butterfly, if I wanted to go cheaper. Or I could do an unbalanced put butterfly on the other side if I expect a pullback. So profit taking is always set on ranges and levels, right? So if I look at AVGO, where's my next level that I'd be setting? I'd need to do my Fibonacci here. But I looked at 520. And I said, okay, well, I'm going to stick with 520 as my first target. So that's why we did the 40 wide call debit spread to start with. So when you take profits, always have an expectation of where the stock needs to be before you start, taking money off the table. Because a lot of people are driven by their P&L. They look at a trade and they go, oh, my trade's up 40%. Let me do something. Whereas it could be up 40%, but the stock is here on just about to break out to the upside. They don't even look at the charts. They just look at the P&L and take their money off the table and then miss out on those big moves. So that's one strategy that I use. The second strategy that I use is called time and trade. I give the trade enough time to do what it needs to do. And if it doesn't do what it needs to do in that time, I'm out. I just get up. Right. So, for example, leading up to earnings, I will not hold a trade through earnings. So if I put a trade in, I will close it on that day before earnings, regardless of the profit. Right.
So looking at AVGO here, it looks like earnings are coming up pretty soon.
So I've got about 4 days to go. So I'm looking at the put spread before earnings. Remember, I'm going down quite low on my strike. So my strike on my put spread is down at 475. So I'm underneath the 34. I've gone underneath the 34 for that. Give me 1 second.
Bye.
Yeah.
Bye.
Bye. Okay. The joys of parenting. Okay. So this here, the 34, I'm selling my put spread underneath. I'm going to go 1, 2, 3. Earnings is on the 3rd. So that's on Friday. So maybe hold the put spread for a couple of days, rush into earnings. This might go up in price, and then close all the trades, wait for earnings to finish, and then repeat the trade straight after that. So I'm not too worried about stocks like AVGO, especially if I'm selling my put spread down here. Not too concerned about that. But that's the logic, right? You've got to make sure that when you have a trade, in order to take profits effectively, you need to have an expectation. What was your expectation when you did the trade, and where do you want it to go? If you know where it's going to go and you see it not going there, you can exit the trade. If it gets there, you can then take the trade. Look at Google. Google's a better example. So Google, when it hit this 21, when it pulled back to the 21, and you'll remember this, we did the trade of, we wanted to trade it up to 2,900, right? 2,900, somewhere over here. This is where we wanted to trade it to when it pulled back to the 21, right? So when it pulled back to the 21, we landed up putting in a whole lot of put spreads. We did out of the money put spreads, and we did some in the money put spreads. So that was the key. We put some in the money put spreads on that pullback, that 2,900, or we actually didn't do the 2,900. We did the 2,850, 2,800. It was out of the money at that point. We sold the put spreads for the move here. Look at what was happening to the squeeze. When it pulled back, we had a squeeze forming. There it was. There was the squeeze forming. So we know we build trades when the red dots start to form. So when the red dots start to form, we were building our position. We knew that it would fire up to the upside. Bang, we took the trade. Now we're sitting, knowing that the stock has hit the level that we expected it to go, although the put spreads are not giving us 100% profit yet. They're at 30%, 30, 40%. That's fine. We take the profits now from those put spreads, and we can reset our trades when Google pulls back. So if Google pulls back down to any one of these price points, we have an opportunity to re-enter into the trade. And that's how we build Google. It's almost like you have to have a story in play. What's the story you want from the trade? And profit taking will be part of that story. So you set the story up front. I'm going to trade it from here to here. When it hits this price point, I don't care what the P&L tells me. I'm going to exit the trade because the underlying has made its move. So that's story number 2.
You're
right?
basing your profit taking on the movement of the underlying stock.
Always, always, always. When you've got an option's value is determined by the underlying. So if you're not watching the underlying, you're missing out. Don't just watch the option. The option has 3 components of price, right? Time, volatility, and the underlying. So if you're not watching the underlying, time and volatility can go to 0. So that's why when we buy an option, we don't want to pay too much for time and volatility. So the delta of your strike is really important, and the composition of the option is really important. So you don't want to overpay for the things that are guaranteed to go to 0, right? You always want to buy the right option. So when you look at a graph, you've got to have an expectation of price movement. What do I expect the price to do? Do I expect it to keep going up? Do I expect Google to pull back down to the trend line? No, Google doesn't come down to the 34 very often. So trading Google on a volatility range, using the put spread signal, for example, my strategy for put spreads doesn't work on Google because Google doesn't trade to the bottom of its vol range very often. You have to trade Google on the moving averages. So when Google pulls down to the 21 or the 34, that's when you get in. That's your buying signal, is a pullback to the 21 or the 34. So expectation now on Google is either going to be rise above 29.04, chop around here, and then move up again, or it's going to pull back down to 28.38 and then bounce, or it's going to pull down to here and bounce, or it's going to pull down to here and bounce. It's going to do one of those 4 things. It's not going to do anything else. It's not going to go from here to there. You know, it's not going to do that. It's going to stop at these levels perhaps. So we need to be patient. You've got to wait for it. Does it pull back to the bottom of the range? No, I don't think it's going to do that. So profit taking, a lot of people will always, well, my students ask me, when should I take profits? I go, well, what does your plan tell you to do? If your plan tells you to get out of a credit spread at 60% profit, auto close that at 60%. Just set it up there when you've done it at the beginning. When you get into a trade, just set it up and let it, you know, credit spreads are easier than debit spreads. So with debit spreads, I usually aim for a 70 to 75% of the max gain. All right, so 70 to 75% of the max gain on a debit spread is my target. The reason is I have to leave something for someone else. You know, at the end of the day, if you try and take 100% max gain on everything, you've still got to exit the trade. Someone's got to take something, you know, got to leave the guy the last crumb, right? That's the thing. So leave someone else the last crumb. Don't be a greedy guy.
It's harder to get out if you're at those levels, though, if you're trying to.
It can be. If you leave it too long, it can be. Sometimes you get lucky and you get these early morning volatilities, you know, sort of washes where you have these spreads widening and you could get lucky. I've only had that like twice. So debit spreads and credit spreads are easy for profit taking because you can automate that up front, right? You can just set your profit target goal, let the trade work out. If this, if the setup's being correct. Where it's difficult for people is long calls. So single leg strategies are difficult because the profit at the beginning of the trade is unlimited. You could make a ton of money. What happens if I get out now and tomorrow it doubles again? Well, read the signals. If the signals are telling you there's a high likelihood or high probability of that happening, then buy another call option, take your profits off the table and keep peeling it off. If you don't think that's going to happen, take the trade off the table. If you plan for this up front, you would have had enough contracts in play so that you can peel the trade off contract by contract. And that's how we play the swing trades. You know, when you've got swing trades that go this way, you buying one, then you buy three, then you buy five, or whatever it is. On any type of down day, you're buying more. Eventually you accumulate 15, 16 contracts that are all profitable. And then as you start hitting price extensions where prices tended to be above the third Keltner, close two, then close two, then close two, then close two, and then you peel it back. And that's the safer way to do it. Profit taking is just very emotional for people. There's a bit of a dopamine rush that they get when they trade. And suddenly they're taking money, you know, I'm making some money. What do I do now?
That green is really exciting, Chris. Like green.
The green should be, you should be agnostic. I don't really care if it's red or green. At the end of the day, you go to your P&L, you look at the sum total of everything. And if everything is still positive, that's called a winning business. If you treat every trade if you trade to be right on every trade, it becomes very frustrating because you could be right and still lose money. You know, you're not going to be profitable.
I've done that.
Yeah. So
I paid way too much for an option. I think I ended up, well, I didn't actually lose money, but you know, there were a lot of people making a lot of money and I made like $5.
Well, you know what the thing is, a lot of people tend to want to do, you know, when they're trading, a lot of times the greed factor goes over, right? It's like, or sometimes it's based on the alert. Where did you get the alert from? You know, you get the email from me, for example. It's like, shit, I got to do it now. If I don't do it now, I'm not going to do it. And then I'm going to lose. And no, like I always just say, people, don't chase things. If you've got, you know, let's say you're a member of a service that's giving you alerts from a Discord server or whatever, just put it through your filter and you'll see, are you paying too much? Is the setup right? Is this there? Is this there? Is this there? Meet your rules and then do the trade. And it might take you an extra day and that patience pays off. At the end of the day, that patience pays off. There's nothing wrong with getting an alert. It's just how do you act on it? Do you randomly go and do it just because it's come? Or do you put it through a filter that allows you to determine at the end why the trade worked? Because if you know why the trade worked, you're learning to be a better trader, not some dependent guy who needs the the adrenaline rush of an email pinging on your phone. Like, that's not going to be cool. You know, don't do
the
that.
trade, the Alpha Hunters trades, I know you always give out a little bit of information about the trade with it.
Yeah.
So people can use it for an example to learn, and not, I mean, obviously it's actionable, but it's, you know, a learning moment too.
Absolutely. Every single trade, whatever service you get anywhere, should be a learning moment. It's like, you're not going to be a better trader because of the quality or because of the quantity of alerts you get. Like, you know, it's very easy for me to sit here and send 100 trades. I can do that. If people want 100 trades, I can give them 100 trades, but I'd give them 100 trades that they can't act on. You know, and if you can't action that information, there's a problem. That's number one. Number two, if you don't know why the trade is being done, so you have no idea what's driving the trade, what pushes it up in price, which signals are being used, you're at a weakness. You've got a disadvantage now. So you have to have a process by which you look at a trade and go, I understand why I'm doing this. Here's what I'm going to do. So that's the process that people should follow. And then you become a better trader. Over time, your profits will increase because of that.
Yeah. Great information as always, Chris. It's just a few minutes before the bell, so let's sign off until next week, but I appreciate your time.
Look forward to seeing you then, my friend. And hopefully my knee will be 100% by that stage.
Yeah, I hope it feels better. Heal up fast.
Yeah, it's nearly there. I just keep giving my back now. So now I've just got to solve that problem. My neck I got cranked the other day, so my jaw is really sore at the moment.
The same injury, it just moves around. I'm convinced.
Yeah, it's the same pain. It just goes into different parts. Yeah. Take it easy, my friend. I'll see you soon.
Take care, Chris.
Okay. Bye.